Good morning and welcome to Trading with Larry. I'm Larry Benedict, joined every day by Eric Shamalov in Brooklyn, New York. And we had a down day yesterday, folks. I did pre-shave. I was going to let it keep going, but we had a fake down day Friday. But we actually had a down day. I think we may follow it with another down day today. A little bit too early to tell. S&P futures up 5. We have that rotation into technology again and out of Dow, which they were rolling the other way yesterday. They're coming out of that trade. And right now the S&P is up 5, Nasdaq up 50. You're talking about small basis points across the board. Nasdaq up 20 basis points with the S&P flattish and the Dow down. And talked a lot yesterday. I thought we had a really good podcast. We were really touching on a lot of good areas. One which is really following through a bit today is the bond market. And when we were on the air yesterday, the 10-year was at 433, and it's now it got up to 443. It's now 441.9. But critical areas and slowly grinding higher. I know you said yesterday you like the 30-year sector. I'm not touching that, not liquid enough, and trades it really, like when we used to trade it a lot. So, I'll back you up into the first time I ever traded bonds, which was pre the 1987 crash. So I would say it was probably 1985 when I made my first bond trade. And really, the bond of choice was the 30-year. And, Tom Baldwin, who's one of the greatest traders of all time, was a pit local written about in many books. He was the axe in the entire bond pit, and he was as big as any institution out there back in the time. But we traded 30 years. 10-year wasn't even an instrument of choice at that time. And then I would say late into the late 90s or even into the 2000s, maybe mid 2000s, like 2008, 7, 6, 10-year became the focus. So for me, I shifted all my trading, which was thousands and thousands of bonds a day. I mean, I traded that thing so aggressively and actively. And then we switched to 10-year because the movement in the bond was too crazy. And there were days where the long bond, now a big move is 20 ticks, you know. Now, back then, we had days that bond moved $6, 6 full points, 4 full points, and they blew people out of the water. So people kind of moved away from that and moved into trading the 10 years. So that's the vehicle that I'm going to quote. That's the vehicle that I'm looking at and I'm talking about on a day-to-day basis. The 30-year, the yield curve is steepening as the 30 gets closer to 5%. The last time that happened, bonds were 10 years were significantly higher. But either way, bond looks like it's having a yuck morning again. Yields are holding here at 442. We're going to see if we get that move this week to 4.5. And if we do, I think that's going to put a flag on the field for the stock market. And it's going to make it very difficult for, people to find reasons to buy equities as bond yields continue to rise. And again, this isn't as a bull, which you are. This is not a great opening in equities. I don't like it. I would have rather seen after, the first down day of any significance, a little bit of follow through. You saw that after the close when the futures basically traded from 4:15 to 5 o'clock. We were down about 13 to 15 handles on the S&P. Not a big move, but then when the night session started, we continued to creep up, and we didn't go up much, but we were up like 10 points, 12 points on the S&P. Very tight range today. So, for me, looking at the market as a professional, I'm looking to see if this market's going to hold today. That's the first, line in the sand that I'm looking at. And as we're on the air, S&Ps are leaking lower and probably will not probably will not make the opening upside. So it kind of takes away a lot of the mantra that I like when you have a down day that's pretty big, and then you get an up opening uh, that's not really an extended follow through that should be sold. So right now, really not a lot going on, and we have to respect the market. Obviously, in an uptrend, we had 8 up days in a row off of the Iran news, which is in the rear view mirror, and now we're trading a slightly different market that's showing higher yields. Dollar's kind of weird. Cannot pick up any strength here at all. Last night actually traded weaker overnight in Asia and Europe. Came in a little bit this morning to get closer to flattish. Um, Oil still is holding a bid. I don't know if they're thinking maybe there's going to be some kind of situation overseas or what it is, because over the weekend they had OPEC basically up production and basically say they're pumping oil into the market. Market was $1 lower on Sunday night, reversed that, ended up $1 plus yesterday. Not a big trade there. But just looking at the board, across the board, gold leaking. Gold looked terrible yesterday. It was down like 35, reversed and almost closed positive. And then now it's down like 7. No trade there. Still like it lower. I know you like it higher. I don't know. Why do you like every market higher? I'm going to throw it to you. I'm
I
doing a
like.
lot of talking. So I
I
want to know
told you
why.
2 weeks
First thing I
buy
want to know,
everything.
dude, I want to know why you like every market higher. And literally every market. You love it. So I'm going to throw it to
I think it's
you.
beyond the scope. It's beyond the scope of a half-hour podcast. But buy everything has been working. You buy gold. You buy the market. Well, not buy everything. I'm short bonds, Larry. I'm short the euro,
But
so it's not
you
everything.
probably want to be but being short bonds is really being long yield. So in technicality,
So I'm long
you are
something, right?
long.
Okay.
You always long. So we'll find a way for you to be long. Anyway, I'm going to throw it to you. You can give it a little insight into what you're looking at today. I have some stuff to talk about
I'll
after.
give as little insight as possible.
You will?
Well, you said give a little insight, so I'll give as
Okay.
little insight as possible. But
Wow,
here's
you're trying to be funny today.
I'm trying. I'm
Stick
trying.
to your
I'm
game. Stick
trying.
to your game.
So this is the bond chart that Larry was referencing. This is the 30-year chart. Looks a little messy, but uh, down here, over here on the left in the green box, this was Liberation Day. I just want to take it back to Liberation Day, and yields really popped on that. And if you kind of zoom out and look at this chart, the trend set by Liberation Day is perfectly intact. Um, the the consolidation here is over from a technical level, and maybe last week's jobs report nailed it in the coffin that we're not getting rate cuts anytime soon. The next time the market thinks we're going to get a rate cut is going to be in September. And you mentioned uh, at some point yields are going to put in a flag for the market. That could be as early as next week, although I think any negative reaction on the CPI report will probably get bought. I think it'll take a couple of hot inflation reports to really get the market on edge about what the Fed is going to do. So we're going to have a inflation report next week. I think it's going to be an interesting one because I think it's going to come in higher than people expect. I don't think it's on anybody's radar at all. So yeah, we were talking about the 30-year getting to 6%. You laughed at that notion yesterday, but I think we could get there. I think we could get there. And in terms of the stock market today, look, I mean, yesterday's down move, I just felt like the market was going to want to react to some played out tariff headline, and we got a couple of those yesterday. But if you notice, like the moves on these news headlines, they're still there. The algos are still in control, but it's like at a decreasing rate. Like the reactions are much smaller. In the beginning, you had 200-point swings on a headline. then it went to 100, and now it's 10 per headline. So I don't know. I don't think the market is in big jeopardy here up until we get uh, a couple of CPI reports in there, and I'm still thinking iron condor for today. I don't think the position I had on yesterday is pretty much
Yeah. I
it's another
mean,
iron condor day, Larry.
I guess that's what you say every day. So it works until it doesn't. The only thing that I would say to our subscribers out there and people that are listening in, and I think this is really important, and it's something that a lot of people don't talk about in the market. And there's, they call them, I guess, in the newsletter space, gurus or I don't even know what, they use the word guru or leader or whatever. And what I would tell you is the beauty of what we do is define risk strategy. And define risk strategy is very different than what everybody is doing in the market. So basically, a defined risk is when you know the what you can make or lose. And doing our strategies throughout all of our products, it's defined risk. I see a lot of people out there, and it may include you. I'm not 100% sure, but they're selling naked puts, okay, on individual equities, or they're selling naked calls, or they're putting customers at risk. Basically, a margin risk because you have to have a lot more margin to carry a stock that you get delivered, okay, both long and short, than the defined risk option strategy, which the beauty of options is for a few $100s, you're controlling 100 shares of the most expensive. You can control 100 shares of MicroStrategy for $300 or $200. You can even control it for $50. So the defined risk strategy is what we do here. It makes us different than most out there. I would not subscribe to any strategies that are selling naked options at all. We kind of do that. So when you talk about, we can get a lot more granular here today. When you talk
Yeah,
about, your iron condor, you're selling a put spread and a call spread,
right.
around the market, and depending on how aggressive you want to be, you take in more money as you get closer to the strikes or the money as they call it, or you can go farther out where you're kind of relaxing, and the only way you really get hit is if we have an extreme move in either direction. So that is that spread. But what we're adding the second part of the leg that makes it an iron condor. So really you are selling a naked put and a naked call. It's not naked because you're buying a hedge around that. Now, if in fact your hedge helps you, meaning hedges you and basically stops your loss, that's a very bad thing. So we don't ever want our hedges to come in, but there have been many times, and I've seen it during the financial crisis when Lehman fell apart. These options that we spend money on to make sure that our customers and our clients are hedged, okay, come into play and quote unquote save our ass. Okay. And it's happened before. You don't want it to happen, but it changes the mantra of what, what you're losing. And by selling naked, it just opens you up to a lot of margin issues and undefined risks. So what we like, or what I like in our strategies at the Opportunistic Trader, is defined risk strategies, meaning we know what our customers or our clients or subscribers are making or losing on every single trade we do. And, for people out there that do trade with me, a lot of times I let these options go to zero. There are times where we probably could get out and save a little bit of money, but we know going into each trade what we're willing to risk. And as long as you're under control and you follow the strategy, you will be all right over time. But what I really wanted to impress on is these are defined risk, everything. We're long options on a lot of our products, that's defined. And then on our spread products, we're selling spreads with a defined loss limit. So it's important to do that. Yes, people do use stops and whatever, but a lot of people I see out there are just selling naked options all over the board. And it's not really right for retail public customers. I think both on a margin basis, on a risk basis, it's very important to add the second leg of that hedge to hedge out the top or bottom side of your risk. So what you'll see from us is spreads, not outright nakeds. Now we're getting kind of the same feel as doing a naked option per se, but we know that we're hedged. So let's say all of a sudden we're sitting here, we're on the podcast, and all of a sudden some really negative news comes out, whatever that could be, and the market falls 300 S&P points or 200. I know it's you don't believe it's possible, but
No.
exactly. And but the thing is, we know the most we're going to lose on a 20-point spread is 14 points, and we can
Right.
live with that. We don't want to live with that. That's a very bad day for us, and we're not happy. But if you don't have that hedge, you could lose the full amount of money, and we never want to have that happen to any
Yep.
customers. And I think there's a lot of people out there, especially in the option game, that don't have a lot of experience, that are selling strategies that are not right for our retail. Because listen, we have professional traders that are trading on the Opportunistic Trader subscription service. I see, I see,
That's a fact. I know that for a fact.
I
Yep.
see very large orders coming in. So I know we have professionals, and I appreciate that. But we also cater to a lot of retail, so it's very important, for us to make sure that our retail audience. I trade. Um, or give ideas and thoughts out to people I know that are in their 80s for a fact that trade with me. So I want to make sure, they're obviously not in a position to make back money if they lose it, that we protect them from, suffering a catastrophic loss or a loss that's sort of outside the box. So, that's what we're doing here. I wanted to talk a little bit. I actually put on a position um, in Tesla. I sold some puts on the downside. I sold a put spread, um, and that is about now $20 out of the money for Friday. I feel pretty okay about that. I mean, if Tesla goes down that much, I don't mind owning a little Tesla, maybe at 267. That's sort of the area where I would own it. Otherwise, I'm going to take in a small premium. Did that trade, put on a bond short by buying
That
puts.
looks good today. I mean, Tesla's up today pre-market. By the way, a lot
Yeah.
of stock. The market breadth pre-market is pretty good. There's a lot of green out there.
Oh boy, Bull Johnson. I gotta tame the bull, bro. Relax yourself, okay? We got
It's
we got a we got a little work to do here, my son.
Look, I'm not
I
that bullish. I showed that chart of the bond yield. I think there are it's like walking and chewing gum at the same time. There are
you were
two.
bullish yesterday on this
Yeah,
podcast.
I'm bull, but that's
But
there's two
what
things
I'm
going
gonna
on.
listen. I'm gonna throw. I've been mellow for a lot of days here. People watching, I am not on any medication. I'm just very relaxed. But I would say, to be
That's
honest
a
with
great
you,
way to preface a statement. I'm just warning you. I'm not on any
I'm
medication.
not. I'm very relaxed. You haven't gotten
Okay.
me where I've gotten really crazy. So I know people are waiting for it. It will be coming probably in the next few podcasts. But
I
but
hope so.
but I
I
would say I talked a little bit about it yesterday, and I'm looking at it again, and I think the way we get the moves that we get, they don't really make sense, but they happen. And the reason why they happen is because people are sided. So, like, to get an extended up move, especially from the levels we're at now, people have to get sided. And when I say sided, I'll explain what that means. So, like someone like me, I was looking at all the news pre Iran. I'm like, listen, the market doesn't look that great. This war may last, da 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 da, and then I'll short the market. And then the news comes out And even though it may be not that great, in this case, it was better than expected. Original, it wasn't. The market traded down over the weekend, but overall, I got sided. People got sided, meaning the base was short. And right now, the base isn't short because the base covered. Okay, I covered, everyone covered. So the base is back out. So the only way to get that extended move, especially the crazy move we saw in 8 trading days of about 8%, is to side people. And right now, people are not sided. And the news that I'm looking at seems to me to be skewed to the opposite direction. And like now, even when we got on the podcast, yields are up another 10 bips. Not a big move, but we're creeping. We're now at 443. I mean, we could close the day, depending on what goes on, at 445. Then your next stop is 450 on a quick, maybe. And at some point, these bond yields are going to mean something. So let's look at what I was talking about. There's something called sided. So people are sided. So that means like tilted. The market was tilted to the short side, thinking, we've had a huge move up. Listen, think about what we did. We went up over 30% off the bottom and then had an 8% move in 5 days. That's one in 100 chance that you see something like that. But the market was leaning short. They blew people out of the water. Again, I don't see that short base. And now I see stuff that's making me look like the market is going to have a little bit. Listen, the market had a crazy move. I'm looking at the S&P up 5% for the year, almost 6. We were down 20. I mean, that's a crazy move. We were down 20 and 25 from the high in Nasdaq, which is even crazy, down over 30, and and is now up 5. So we've had crazy moves. Market's gone, parabolic to the upside, but now some things are looking very, very skittish. I mean, 10 years down 12 ticks today. That's a fairly decent sized move in the 10-year. I mean, it's not the biggest move, but you get another 5 ticks in here and you got a jobs number type move today with really nothing going on. Tomorrow we have FOMC.
Yeah.
I don't think that's really going to be a major player in the market, but definitely something to watch is what the Fed is thinking. And obviously, right now, as you said yesterday, the move for July is off the table, 0% chance, pretty much. Okay, and now we're heading into August, September, and believe it or not, when we're in September, we're in the fourth quarter of the year. They didn't get 6 rate cuts. They didn't even get one, and the market's still higher. So, I mean, I know the market just,
Yeah, but
always
that was the
wants.
case. That was the case in 2023. The market thought we'd get rate cuts. We didn't get rate cuts. The bears were like, "Oh, we didn't get rate cuts, therefore, market needs to drop." Say, remember 2023? That was you had you had Silicon Valley collapse in the first quarter, right? And then when everything was okay, they didn't cut rates. They didn't cut rates, and the market went on a 2 year bull run like there's no tomorrow. 2024, same thing. Everybody's talking about rate cuts. We actually got rate cuts, but much less than expected. And by the way, the the rate cuts at the end of the 2024 that didn't really result in. I know these things aren't correlated, but like the market didn't go straight up on that. So I just don't think that like sometimes rate cuts, like sometimes interest rates matter to the market. And I would just say if you really look at it, maybe most of the time it actually doesn't matter for the market at all.
No, listen, whether rates are 450, 460, or 440 is irrelevant over time. It is relevant. One thing that I've like thought about, on the outside when I'm not trading. Think about this. You're a fairly wealthy individual. You're retired. What's wrong with getting 4.5? You were getting zero. I mean, the whole
The inflation rate. The inflation rate is the problem.
Why? Inflation is at
But that's
2.6
your
or
hurdle rate. I
2.3.
mean, yeah, you
Good.
could be picking
The
up
the
four
inflation
and a
number,
half, but if inflation is 4.5, also, you're not making anything.
dude, listen, I'm just letting you know if inflation is 4.5 or 3.5, how is that? How are you seeing that affecting you? I mean, I don't even know what they're using. Like, if you look at the CPI number, which we should do on this podcast, there's things in that CPI number that you can't even believe. They have zero to do with anything that anybody has on or is using in their life. So, I don't really think it matters. So let me ask you this. So then how do you deal with it when rates are at zero and inflation is 2.8 or 3? So let's say inflation right now is 2.6, 2.8, even 3.2. At least you're getting 4.5. You're on the positive. And then if you're looking at munis, you're even more on the positive. So all I'm saying is there is alternative to the market. Obviously, it's like an insatiable appetite to continue to buy stocks and buy stocks. Listen, I talked to a very old friend that we started trading together. And here's what's incredible. Okay. We traded together. There was very little retail. The retail was multimillionaires. It wasn't guys in their underwear in their basement clicking buttons on their phone, okay, with $10,000 accounts. To trade options in the
That's
retail,
a
you had to be
perfect that's a perfect visual, by the way.
I'm just saying you had to be a multimillionaire. And not a lot of people had access. But here's what I want people to understand, and this is where I'm having a problem. Okay, the most expensive price stock in the stock market was a stock called Teledyne, but no one really traded it. It was like 300. Okay, but besides that, IBM was the bellwether that everyone traded, Eric, and it was $100, 160. Okay, guys are trading $1,000 stocks, $800 stocks. Meta, who can buy Meta? It's $800. I mean, how much stock can you actually buy as a retail customer of Meta? Not a lot. So how is that investable? Like the prices of these stocks are so high and people don't care and they're going into $800 stocks, $400 stocks. Very different mantra than what we saw when I grew up trading, where the most expensive stocks were $100. Okay. Now people are buying quarter unit shares through an ETF that's triple leveraged, etc. How is
There
this
you go.
between
You just answered your own. That's it right there. And I
yeah,
would
but
add
how
in
is that a
options.
positive? They're buying on massive leverage. There's something called structured notes, which one day we'll get into also. But basically,
Right.
they're basically strategies that sell naked puts in the market, with some hedges, but very little. And they're
Yeah,
giving
but they pay you a yield.
13%, 12%, and no one loses. I've done them, many of them. I've never had a losing trade. Okay. But one day the S is going to hit the fan and it's going to get crazy out there because there's billions and billions, probably trillions in structured note products. There's, billions and probably hundreds of billions in all these levered crazy ETFs because you're getting inherent leverage without getting leverage. So most people in the traditional have to open up a brokerage account, okay? They get margin, okay, and they utilize margin. They have to pay for margin money, okay? You're paying 10% for margin money or whatever. Maybe if you have a better account, you're down at 8, 7, whatever. Some accounts are even higher. But now you no longer need to borrow money from your brokerage firm. You can just buy a triple levered Tesla or a triple levered
Or a
MSTR.
call option. Or a
What?
call option. Or a call option.
That gives you
Mhm.
leverage on top of the 3 times leverage. Now you're leveraged 10x or more. So what I'm saying is the market is so levered here that it's actually an incredible thing that it continues to rumble on the way it has. And then I was reading something yesterday that this in the last 6 months has been the biggest retail buying in the history of the stock market. Okay. So I don't know what happened, but they were buying January, February. They got incinerated in March. Okay. They definitely didn't buy in March. We discussed it. They missed 600 S&P points minimally, and then they bought again in April, May, and they're buying again. So, like, I'm just thinking there's just so much risk in out there that it's a little bit crazy. That's what I'm seeing. Again, you can't fight the move. You just got to sidestep it. But I just think, and usually I'm early. I have it right. I'm early. I was early in '08. We crushed it in '08. We had probably one of the best years out of any trader on Wall Street, literally all of Wall Street. And we ran $1 billion back then. And we had almost a 20% net return to investor in '08. Okay. And a lot of what I'm seeing now, it's different because that was really caused by a structural collapse in the housing market and leverage out the wazoo, and the fact that these banks were basically selling naked puts to all of these hedge fund managers,
Yeah,
Paulson.
to each other. They were selling naked puts to each other.
Well, I know the banks were selling them to hedge funds, and then Goldman wouldn't mark the positions correctly, even though they were losing money. They wouldn't let these guys win, and then all of a sudden the house of cards fell. So I'm not saying we have full similarity to that, but I think we have a lot of excess leverage in the system. I think by them structuring ETFs every day, a lunar landing on the moon versus a rock hitting the moon times three, reverse backward, da 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 da. I mean, that's what we have. I'm telling you, we have crazy ETFs that are out there giving massive inherent
Okay,
leverage.
back then you had real estate as the risk in the system, and a lot of people, as we were getting close to Bear Stearns and Lehman collapsing, a lot of people were flagging that already. Um,
Well, I was not flagging the actual housing collapse, but I was flagging risk in the system. Okay. Inherent crazy risk. And I'm seeing inherent crazy risk now. I'm not talking about the
right, and
structural
where is that in
dynamic.
particular right now? Do you think is it just in the leverage, or is there a particular thing like back then? You can say, okay, it's real estate. What is it now? Do you think?
Leverage. Inherent leverage given to market players that should not be using inherent leverage and don't understand the risk and the potential movement of stocks on a dislocation. Think about this. MSTR is $400 a share, basically. It was like $80 or lower before this move started. Okay. This, you and I both know that the numbers don't add up. All the company does is buy Bitcoin and sell stock to create leverage to buy more Bitcoin. They don't own enough.
Very easily replicable, by the way. But go
What?
ahead, go ahead.
Very what?
I just want, yeah, very an easily replicable strategy. There's so many Bitcoin treasury companies
Well, they
popping
don't
up
want to
now.
replicate the strategy, Eric. That's what I just told you. They just want to buy the thing with the most leverage. Okay. Why replicate it? You're getting okay, let's say they're 2-to-1 Bitcoin. They're not trading at a 2-to-1 Bitcoin, they're trading at a 5-to-1 Bitcoin, just because there's so many players in inherent leverage. But my point is there's structured products against this, like MSTU, which is 2 times leveraged MSTR. Well, if MSTR has a really bad day and goes down 100 points or 20%, this thing is going down 50% a day plus, probably more because it's going to dislocate because hedges aren't going to be correct. Okay. So, that being said, that's what I think potentially, and it's not now, but potentially the advent of all these levered ETFs that are giving people leverage without having to borrow money or put up money, it's going to take people out of the market. It's not here yet, but it certainly looks like it's coming. So I would say in '08, it was, the system breakdown in housing and, a lot of banks overvaluing real estate, lending money against it, etc. But there were underlying cracks in the market a year before that happened. And the market was at a freaking record high in 2007. I had people parading in and out of my office every day. this market's not going down. I go, this market's going to collapse. So I'm not I'm not sure what or how this happens, but I do think that there is massive leverage in the market right now. And I think there's a massive retail presence in the market. And back in the day, when I was trading in the 80s, 90s, and even into the 2000s with hedge funds, especially, we would know we could own the public. With $1 billion hedge fund, you were considered fairly large, right? Now it's a joke. You'll be run over by retail like there's no tomorrow, and no hedge fund because
Exactly.
of because of
Exactly. That's why when I say, "Hey, Larry," and you and I talk in private about the market and stuff, and I'm like, "Hey, I am actually banking on crazy." This is exactly why. It's because there's such a big retail presence, and they are particularly emotional, behaviorally driven investors. That's why when I say I'm banking on crazy, it's because of their presence, and I don't see them going away anytime soon.
well, you're banking on crazy. I don't think it's crazy. It's just, listen, the whole
Oh,
lot.
they can get crazy. You think something is overbought because of the retail presence now? It'll get even more overbought.
I'm not saying it won't, Eric. I'm just saying they're doing it on very light volume, especially the last 8 trading days that were up. S&P had light volume every day. I talk to the street. I get market on close imbalance. Even yesterday, which was a crap day, there was market on close $1 billion to buy. Every night there's $1 billion to $2 billion to buy. It's not the biggest number, but it's every night. Nobody is looking to get out. The market is extremely frothy. Listen, I think it's great. I'm chopping around. I'm making money on a day to day. I'm focused short gold. I know you love gold. I don't see how is gold holding up with a bond yield going straight up and the dollar crap. Okay,
When was the
I don't.
last time? I'll answer that question. When was the last time? I guess I'll answer it in one phrase. Central banks, they have an inherent bid to buy gold,
Wait, so
and
they're buying gold and Bitcoin and what else?
I
Five
know
other
about
things.
they're not buying Bitcoin yet, but they are buying gold,
What do you mean they're not
and they're
buying
going to continue
Bitcoin?
to buy
There are
gold because
many
there's
central
this.
banks that own Bitcoin. Many. Okay. So they've bought Bitcoin. They, they have,
Buy that too. Bullish on
they
that
own
too.
gold. They own gold. But listen, it makes me laugh. Like I remember when Elon came in and they were going to open up Fort Knox. What happened there? There ain't no gold in there.
I really wish
That
they
place
opened
is
up.
empty, my
Come on,
friend.
stop. You don't think there's any gold in Fort Knox?
I'm not 100% sure. I mean, if there is, why don't they show it? They don't want to show it. They want to hide it. Come on.
Okay,
I'm not 100% sure what there is, and that doesn't matter. Listen,
there better be gold in
I'm
Fort
looking
Knox.
at listen to me. This is what I want people out there to understand, okay? And I'm trying to give trading insight and how I look at the market or how we look at the market. Even though on gold you're bullish, I'm looking at the market with 5 different clues that I look at. And those 5 clues, they're like flashing red lights. They're flashing to me right now that gold potentially should come in fairly hard here. Let me ask you this:
I,
you yourself
yeah,
say you don't like bonds, okay? So if bond
yeah.
yields are going higher, how could gold real? I mean, gold could do whatever it wants because it's a
There
crazy,
you
right?
go.
Right,
There you
but
go.
fundamentally, it's going to click in, and then when it comes in, like, listen, right now it's down
What is
like.
fundamental about what the holding cost of? I
No,
understand that, but
let me go over what I'm looking at. Okay. Gold's down like $14. No big deal. Okay. We're we're about $15 higher than the low yesterday or 20. Okay. At some point in here, CTA is a long max right here. Okay. At some point, when we get to 32.90, we're going to be at the low end of the range. And the commodity is still up 25% for the year. Okay. It's not like it's doing badly. I'm looking, for a 10 to 15% correction at some point. Especially if yields keep ticking up and the dollar basically, gets a little bit stronger in here. And markets hold up. Like yesterday was interesting. Gold was down 30. Then all of a sudden, everyone's like, oh, we want to buy gold because the market's down, and then it comes right back up and the market came up and then it gives back half the gain. So I'm looking at that. I'm not ready to add. If this thing
I'm a
comes in
gold
another
bull, and I was
$20, I'm going
surprised
to
by
add.
yesterday.
What?
I'm a gold bull, and even I was surprised by yesterday's move. I was texting you on Sunday. Gold looks like like S, right?
Yeah,
Like
but
it's
my
gonna drop.
question to you as a trader, if
It
you think it
didn't.
looks bad, why do you want to be long it or why do you want to still like it? You can make money to the short side. You didn't like it, So I don't know. I'm
I
just
did.
looking.
I
Listen,
mean,
I'm
whatever. I'm not
looking
going to
at
get into
that.
the trading part of it, but it even surprised me yesterday with the reversal off the lows.
Yeah. I mean, there's not a lot going on and it's very quiet to be honest, and not a lot going on. Um, S&P is sitting. It won't come in. It got close to unchanged. It's up. Maybe they'll try to buy it on the opening. I'm thinking fade. Keep an eye on the bond yield. It's 442 right now. Came in. It was up to 444. Keep an eye on that. Dollar looks like it may take another leg up here. So we may get the
By the way,
euro.
Larry, here's the CTA net positioning for gold. I don't know. I mean, it's been trending down. I feel like CTAs are always on the wrong side of the trade,
Really?
and yeah, I always feel like they're on the because they wait for like the moving averages to click. They love momentum. They're like they're like a slightly sophisticated retail trader.
Then they did pretty
And
well
like
in
look
the
at the
They did pretty
no,
well
but
in the
the
S&P.
net positioning is trending down all throughout last year as gold has been rising. It's only upticked their net positioning over the last couple of months, right when gold is going through some turbulence.
Yeah, that's so. Isn't that telling you that they're long and they're suffering? Seriously. So anyway, that's really what I see here. I don't know if there's anything, stock side
Where's the
was weird.
straddle at today? Let's price on the straddle for today. Um, what do we got? It's
Probably 26. It's very low, I'm sure.
the straddle was at 31 at the close yesterday for today, and I'm sure that thing is like a 24, right?
Um, yeah. Um, you're
23,
saying
yeah,
there,
24. I think
yeah,
I'm right on the money. I think it's 24, right?
it's actually disheartening. It's literally disheartening. Yeah, but yesterday's straddle didn't work out.
No, it did
It's
not. And you know
23.
what? I
I,
noticed.
I don't think it works out again. Listen, I 100% think we're going to be on the negative side at some point today. Um, I would be shocked if we weren't. I,
You know,
I
we've
think
had now 2 days in a row where the straddle didn't work. It didn't work to the upside
No,
on
listen,
Thursday.
I have a product that's been tested for 30 years that's made money, and this year we're down money, and that's this product. These straddles have not worked out. They've been very, very choppy. We're being much more selective. There's not a lot in it. That's the problem. Like, I'm usually able to come back from any type of deficit in 3 to 5 trading days, maybe 7, but now it's taking way longer because we have a $20 straddle and I don't want to be involved in that. So it's taking a little bit longer. It's definitely been frustrating. We will be back. I do think, a correction is coming. Gold is actually, ticking down a little bit as we speak. If it takes out, if it takes out 3,300, I think we go lower. But again, I'm focused on that. I'm focused on bonds backing up. We put a short on in Goldman Sachs. I mean, it's working a little bit. Um, I don't feel all that confident, but just the price. Like, look at Goldman Sachs stock; it's 710. I mean, it's an insane animal. It's down 6 this morning. I mean, I don't even go look at a chart. It's like up 150 points, like in less than a month. I mean, these moves are crazy town. So, and again, my question to you is who's coming in and going, I love Goldman at $700 a share. I have no problem buying a $700 stock. There,
So
I'm telling
Goldman, I think Goldman's the leader in investment banking in terms of percentage of its revenue from investment banking amongst all these big banks. And so when I see Goldman like really outperforming like that, you got to think that's bullish because the market would do that. Why?
I
Because
don't know,
of
but I'll
thought
just say
there's
I'll say this.
more deal making.
My son is a corporate attorney and he does M&A and business is slow across the board. So I don't know if it's M&A that's doing this because it's definitely slowing down. You know, prices and valuations are extremely high, especially in that sector. And, you know, there's not a lot of money flowing into private equity. Not crazy like it had been. So I see a little bit of slowdown there, but listen, we're getting close to the opening. It's been very enjoyable today. I've been mellow. You haven't gotten me crazy yet.
I haven't
So
tried.
I'm gonna.
That's coming though. That's coming.
I know, but I'm gonna wrap. I'm gonna wrap, and then I'll throw it to you. You can wrap. I would say today in recapping my thoughts of this podcast, I think other side of unchanged. Not saying much because we're only up 7-10 basis points on S&P. Again, we have a weird day where Nasdaq is outperforming the Dow significantly by at least 30 to 40 basis points. Keep an eye on that reversing today. The trade that has been working, which I discussed a little bit earlier, is long DAX and short S&P. That is back around about 2%. I see a no trade there. Keep an eye on the euro coming through 117 into the 116 handle maybe tomorrow. Again, think bond yields are, I think we're going to be talking about 450 on bond yields before the end of the week. And I think that at some point, if there's any type of correction, it's going to be blamed on that. Again, I don't see how gold could hold up with much higher rates. I think potentially just, it's a slow mover, but keep an eye on that. We might see a little bit more of a down move there. And that's really, what I see. Apple was interesting to me yesterday. It was kind of holding up through most of the day and then sort of got hit at the end of the day. It was down almost 2%, but it was holding most of the day. Up small this morning, probably downside there. It ran up like $10 because they missed the whole AI train and they admitted to it and whatever. I don't know how that's good, but that was really the run up. And, that's what I'm seeing here. And I'll throw it to you to close us out.
Thanks. Yeah, Apple's funny. They're rallying because they're getting out of their own way, which I guess is good. Um, for me, I'm positioned. I already said as if the market really won't do anything today. The VIX continues to bleed lower. It had a little cute little run up yesterday on the tariff headline, which quickly got sold. The VIX is like a blunt force tool. You have zero DTE now, but even zero DTE vol is down from yesterday's close. I don't really see a virus in the market today, but I think the market, as we discussed on the podcast yesterday, and I pulled up a chart, the RSIs on a daily chart for the Nasdaq, for the S&P, are in overbought territory. So I'll give that to the bears. That's technically overbought. So maybe for a few days the market doesn't do much of anything and kind of recalibrates, and that's kind of how I'm positioned. Trading very light here. Other than bonds, I don't really see much.
But you know what's interesting? If in fact you believe all the things that you're saying, it's almost a better market to trade heavier in because premiums should just evaporate. And that's where we make the most money. So I don't really want to get into that
Yeah,
because
if you're selling credit spreads big, like, but that's never the biggest part of my account. The
Okay.
biggest parts of my account are cross asset futures.
Okay.
And I use credit spreads and I use options
I
for
I would
income and for home run swings.
I don't know. I would say there's
Different.
opportunity.
You use credit spreads, you use options. That's the biggest part of your book. But we
That's
grew up in
that's
different.
pretty much that's pretty much most of everything. I trade equities, trade futures, trade mostly 85% option. But listen, we're like literally 10 minutes before the opening. I appreciate you joining me today. Again, I think we gave everyone a really good roadmap today. I'm a little more, you're saying nothing is going to happen and da 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 da. I think we could have a follow up day today to yesterday potentially and make it sort of an interesting week, but we'll see how that goes. And I wouldn't touch the downside of the straddle here. But I wish everybody good luck today, and we'll be back to everybody tomorrow. And I hope everyone has a great day. Enjoy.